This week's Five Things highlights the key signals beneath the news. We cover the market's reaction to President Trump's partial tariff delay, excluding China. Then we analyze how a softer CPI offers the Fed flexibility, though congressional spending's impact may be greater. Folio Beyond's Dean Smith discusses increasing stagflation risks while widening junk bond spreads signal potential economic weakness. Despite the tariff pause, oil prices are falling due to rising inventories and recession concerns. Lastly, we break down bonds, preferred stock, and common stock, explaining their position in a company's capital structure and implications for risk and return. Hi, everybody. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, how you doing this week?
I'm doing well. Gary, how are you doing?
I'm all right. So, Rob, have you started to institute tariff pricing on your employees over there at Flying V?
Trying to figure out what all these last couple of weeks mean, Gary. Obviously been quite a roller coaster, but we've got you all covered today in this week's Five Things. We're calling it the Tariffs for One Issue from Deep Knowledge Investing. So definitely going to be touching on tariffs and what they mean. We also have a great guest on the show today who we'll be jumping in with immediately for the first thing. Gary, Stagflation makes another appearance. We're talking about bond yields, oil prices, and we got Cash and Crow, new intern, as you mentioned, on the show today to break down the educational topics that we have. Gary, you locked and loaded, ready to go?
Absolutely. And by the way, Rob, this is our bonus edition of the Five Things. Instead of five, we have six. So either we're delivering extra value or we're having difficulty with arithmetic. You guys decide, let us know in the comments what you think it is.
Gary, jumping into thing number one. So we are going to adjust from the written version. We have our guests here today. I'll let you do the intro. We are talking about, could the 70s be happening again? Stagflation. Gary, I'm going to turn it over to you to make the introduction and looking forward to the conversation on thing number one.
All right. Thanks, Rob. I'm excited to introduce Dean Smith of Folio Beyond. His firm manages more than $100 million in a variety of bond portfolios. Dean, where are you today?
I am in Seville, Spain, and it's Holy Week, so there's lots of processions and parades and tourists, and it's a lot of fun.
Terrific. I've been there. It is a wonderful place.
Yeah, it's great.
All right. So we have been talking about the possibility of stagflation in the U.S. for a couple of years now. It looks like you think this is more of a current concern. Would love to get your thoughts on it. What are you seeing?
Yeah, I mean, there was a time not that long ago when we would have thought stagflation was dead and buried. We thought that Paul Volcker had taken a wooden stake and driven it through the heart. But there's troubling signs that we may be repeating, or at least rhyming, history now. We've got slowing economic growth that was already sort of starting to make itself more widely felt even before all of this tariff mess, there's no other word for it really, came to the fore. And obviously, inflation has been a problem for the last several years, self-inflicted in our view. It's come down a bit. It's still well above the Fed's 2% target. We can talk about different measures of it and so forth. But if you look at inflation expectations of households and businesses, those have taken a really big jump just in the last 4 or 5 weeks.
Yeah, one of the things that I think we should be looking at, and more people are starting to look at, are default rates. At what point do you think we start to see those spike?
Well, defaults defaults take some time to materialize, right? Because for both consumer as well as business loans, you first have to become delinquent. and that delinquency will take some time to work itself through. You become 30 days, 60 days, 90 days, and then there's some sort of a foreclosure process. So getting from, stress in the economic environment to actually seeing defaults occur can take some time. I'm old enough to remember the financial crisis back in 2008. In fact, I was managing a portfolio of subprime mortgage-backed securities from the short side, fortunately back then. And we, like a handful of other guys, put these shorts on late 2006, 2007, and the real defaults didn't come through until 2008, 2009. So this is something that takes a little while to build, and we're seeing some really troubling signs of it right now. In particular, we're seeing credit spreads really start to gap out. That's both on commercial as well as consumer assets, credit card, auto loans. The FHA has been very kind of quietly forbearing on delinquencies on a huge number of FHA mortgage loans. So if you look closely, you can start to see the signs of some real economic stress building right now.
Dean, we've talked about that FHA issue before on prior editions of the Five Things. My concern on this is I think they are paying the mortgages of people in order to not show defaults and or to show delinquencies. And the issue with that is you have a whole bunch of people who believe they're homeowners, but they have no money in, they're not paying anything. The American taxpayers are supporting that is very selective. It's a selective way to support the housing market. And to make things worse, when that housing doesn't go back on the market, that's how we end up with higher housing prices forever. That's why nobody in their 20s or 30s can afford to buy a house. I mean, obviously not nobody, but it's a huge issue. And I think, it's really easy for people to say, well, hey, these are poor people. We have to keep them in their homes. But when you tie that behavior and the fact that people are paying for it through more inflation, but when you tie that behavior to young people not being able to afford houses, and so they don't get married and they don't have kids, it becomes a very different problem. Any thoughts on what they should be doing with that?
Yeah, boy, this is a tough one. I mean, the FHA obviously has a mandate to support first-time home buyers, um, and one of the ways they do that is through very low down payment mortgages, sometimes as little as, just a couple of percentage points of down payment. Well, if you've got a mortgage and you've gone 6 months, 9 months of forbearance where they're just sort of taking those delinquent payments and putting them on the end, your balance is increasing. So it doesn't take very long if you've only got a 2% equity stake in the property when you buy it. It doesn't take too much deferral of interest and principal for your upside down. You have negative equity in that property. And we saw this, again, not to keep harking on the 2008 financial crisis, but we saw this in spades. And when people don't have equity, their incentive to pay that loan goes down pretty dramatically. And so, how you balance the need to maintain a sound financial system and continue to support low and moderate income homeowners, if we want to still even call them homeowners, if they don't have any equity in the home, is a really tough challenge. And we've got on the commercial side of things, they're doing something very similar. It's not a government program, but the commercial banks who are the servicers for commercial mortgage loans, and there's a huge percentage of these that are underwater, they engage in a process called extend and pretend. So for commercial mortgages, they are typically have a 10-year maturity, a 30-year amortization with a 10-year balloon payment. A large cohort of those commercial loans that were made 10, 11, 12 years ago are well past that balloon date. They can't refinance. And so they've been doing something similar that the FHA has been doing. The banks that are servicing on behalf of the owners of the commercial mortgage-backed securities that in many investors hold in insurance company portfolios and so forth. Um, this is a problem that is only going to get worse. Interest rates, in our view, uh, we've seen the near-term lows in this thing. We actually think that interest rates are poised to continue to stay elevated, if you want to call this elevated. There's no real easy solution here. There's not a lot of appetite for another bailout so soon after the last one. This is going to be a problem that's going to take some time to work out. Um, we talked about interest rates um, being elevated, but that's only if your time horizon is the last, say, 20 years. If you go back and you look at a longer historical perspective, the 10-year generally runs around 4.25, 4.5%. That's sort of the long-term average. So people who think that we are seeing high interest rates right now and are expecting interest rates to return to something they view as normal, two-handle, three-handle kind of interest rates, they're going to be in for a big disappointment. We think that interest rates are going to remain elevated and could go up. We could test the recent highs again of 4.75, 5% without too much additional pressure on the system.
I'm with you on that, Dean. You have a lot of people who don't know a whole lot of financial history who want lots of stimulus, no recessions, low interest rates, and no inflation, which, great. And maybe a pony too. So, one last question for you. Your comment from before was that, people had thought Volcker had killed stagflation. For our viewers who, don't follow economic history in the way that Dean does, he's referring to Fed Chairman Paul Volcker, who succeeded prior Fed Chair Arthur Burns. And so the horrible inflation and stagflation of the 1970s actually started in the 1960s. And there is a story that then President Lyndon Johnson actually picked up Arthur Burns, his then Fed chairman, slammed him into a wall and told him he wanted lower rates. Burns caved and he lowered rates too early and inflation came roaring back. And it actually took Volcker pushing interest rates to around 20%, killing the economy, but that killed inflation and stagflation. Now, for the last few years, we've been saying that this is a story that Jerome Powell knows very well, that he had always, from what I understood, admired Paul Volcker, did not want to be the next Arthur Burns. And yet last September, he let up early, and we have a situation where, as soon as they lowered rates, the yield on the 10-year went up 100 basis points. Basically, the yield curve uninverted, but not in the way they were hoping. Dean, what do you think Powell's going to do now?
Yeah, I absolutely concur with what you just said. Jay Powell remembers very well. He's no spring chicken. Jay Powell is well into his 60s. He may even be 70. He remembers that time period very well, and he has no interest in being the next Arthur Burns. And again, Arthur Burns, you're right. He got pressure from the White House to cut interest rates prematurely. He did so, and we all lived, or those of us of certain age, lived to regret that time period. And Jay Powell absolutely does not want to do that again. In fact, I mean, if you watched his press conference from what it was, 3 weeks ago or so, he basically put his hands in his pockets and jammed them in and said, "We're good. We're good right where we are. We don't feel the need to do anything." And so the pressure that he's getting from the administration, from Scott Bessent, the Secretary of Treasury, I don't think that's going to do much. I don't think it's going to have much of an effect. They really see the problems. Again, go back to the 1970s. What was the catalyst for the inflation that started back then? It was an external shock. It was oil prices. There were some other factors as well, but oil prices, there was an oil embargo, and that really was an external shock that caused prices to rise. what do we have now? We now have an inflationary spike that came. At some people think it's come and gone, and now what are we getting? We're getting a huge external shock in the form of these tariffs. And people who, there's been a lot of rationalization about tariffs and, oh, they're not really inflationary, and U.S. consumers and businesses won't pay them, et cetera. Nonsense. Tariffs increase prices. There's just no getting around it. That's full stop. This is going to be inflationary if these tariffs go into effect to the extent that they've been outlined. Now we've got this 90-day pause, I guess. I put that pause in quotes because there's been some conversation. Well, it's not really a pause, but we have the 10%, I guess, inflation on a lot of things. They're kind of picking and choosing which commodities and which products are not going to be subject to the tariffs. It's really quite a chaotic situation now. But some form of these tariffs is going to come in. Donald Trump has been a fan of tariffs for 35 or 40 years now, and he's also a fan of low interest rates. Remember, he's a real estate developer. What do real estate developers like? They like low interest rates and lots of leverage. So you've got sort of this perfect storm of factors coming together that we think spell some real trouble for the economy and for markets. And that's why, frankly, we've been telling our investors that you need to get rid of this mentality of trying to pick bottoms and trying to time the market. It's time to play small ball. You need to reduce your risk. You need to reduce, and particularly, you need to reduce your duration of your portfolio. That is to say, your interest rate sensitivity. We think that it makes sense to reduce long duration credit risk. There's lots of things that you can do. You want to live to fight another day at this point as an investor, and I think that there's a lot of talk that you see on the financial press and on TV programs and things like that of people trying to be smarter than they really are. We think that there's, the right thing to do is to be cautious here, and as I say, live to fight another day. Preserve capital.
All right, Dean. Well, we know we're coming up on midnight there in Spain. So we're going to let you go. But thank you so much for joining us. For people who are interested in what you have to say, how can they find you?
We have all of our ETF information, the performance, the documentation, disclosure materials are on our website, foliobeyond.com. There you'll find the information on our riser and fixed P exchange traded funds, and for you to reach out to us through the contact information on the website.
All right. Thanks, Dean. We appreciate it.
My pleasure.
Awesome. Good stuff there, Gary and Dean. Thanks so much. If it cut out, yeah, we'll definitely have a link to Folio Beyond in Dean's contact information so you can connect with him after the fact. Gary, anything else to add there?
No, as certainly an interesting segment. A lot of the things Dean talked about are going to come out later in the show. So, we'll be talking more about credit spreads, about the Federal Reserve, about inflation, and about, the Fed's options, which are not as wide as they're not as numerous as people seem to think.
Yeah, Gary, moving into thing number 2, thing number 1 on the written version, but just a little adjustment. Again, having Dean on the show. Gary, we're going to talk about tariffs. Dean even mentioned it a couple times in the last thing. It seems like there's been some pause, some start. Talk about delays. Looks like 90-day delay for everyone but China, which, Gary, you're calling thing number 2, tariffs for 1. Tell us more what we need to know about that.
So, Rob, it's incredible. I was writing this version of the 5 things last Friday, and it had only been a week and a couple of days since President Trump had announced his tariff plan. It feels like it's been, 5 or 6 full market cycles since then. Last Sunday, 8 days ago, I wrote a blog post for DKI Premium subscribers explaining to them how I was thinking about portfolio exposure because tariffs are a big deal right now. And at the time, I explained that there were 3 likely scenarios in the near future. One was a market-crushing implementation of the higher tariff levels that had been disclosed before. The second one was negotiating lower tariffs with the 50, now more than 70 countries that are offering lower tariffs on US goods. And the third option was a 90-day delay of tariffs so that those negotiations could take place. And I wrote that the last one would send markets soaring. Well, we got a combination of options 2 and 3, a 90-day pause to negotiate with, I think it's now 75 countries, including the EU. And big Chinese alternate, Vietnam, India wants to talk. So there are a lot of really important economic partners that want to have these discussions. Anyway, when all of this happened, equity indexes went from down big to up huge, and then much of those gains were wiped out the next day as markets realized, wait, this doesn't resolve the escalation between the U.S. and China, and everybody realized, oh wait, we haven't solved this. We just have another 3 months of uncertainty, and the market doesn't like uncertainty. So a lot of those gains came back. And for people who want to understand the tariff situation better, I would urge you check out on our YouTube channel. There is a discussion we did last week with Alex McCrease, who explained how the Trump administration is viewing and calculating tariff levels. Now, the people who watch that, you may agree, you may not agree, but everybody's saying they don't know what they're doing. They have no plan. They're calculating this wrong. That is not correct. There is a plan, and these tariffs were calculated according to a formula. There weren't mistakes. Now, you might not like the plan, and if that's the case, we should have that conversation. But I think Alex does a great job of explaining what the administration is thinking and where the ideas came from. So that's, I think that's worth watching.
Gary, so obviously, yeah, you talked about the markets fell, and then they rose again, a little bit of down day, big day today, another good day today. With all of that fluctuation, I mean, what are the other implications that you're looking at with this tariff delay other than what we've seen kind of the market rising over the last couple of days?
So, Rob, in the prior segment, Dean Smith of Folio Beyond was talking about what was happening with interest rates and sort of, normalized rates on treasuries. And so not last weekend, the weekend before, we saw the yield on the 10-year treasury dip below the 4% level, which was, I think 80, 90 basis points below where they were just 2 months ago. That is a huge move down. And then they rocketed right back up. I think they hit 4.7, 4.8, something like that. As of right now, 4.4%. So above where they were at that point. Now, there's been some speculation on that because obviously the yield we're getting on our treasuries, or paying on our treasuries, is really important to any financial calculation. And so what a lot of people were saying is part of the move might have been related to foreign government selling. There have been a lot of rumors. China owns, several $trillion of US treasuries. And so they might have been selling. And there also was a lot of discussion related to stress on the basis trade. Now, for people who aren't following this on a regular basis, the basis trade is simply taking advantage of a small difference between the current rates on treasury securities and on futures. And so they'll own one, they'll short the other, and those spreads, those differences in yields are very, very small. And so they use leverage. And these trades get leveraged up sometimes 50 or 60 times. So, if someone has $1 million of capital on this trade, they might have positions adding up to 50 or $60 million. Now, what do you do when their starting capital on that is $100 million? All of a sudden, at a few $1 billion here, a few $1 billion there, it becomes a huge problem. And so there were these widespread fears and speculation that fears of a subsequent bank failure due to excess leverage on an unwinding trade led to the 90-day tariff delay. Okay, so the sort of the chain of events there, rather, is you have this basis trade. It starts to lose money at 50 or 60 times leverage. People realize, oh no, that's a lot of money I could lose. And so they start to unwind it. And as they unwind those trades, the banks that have lent them those 50 to 60 times their money could fail because of excess leverage on this trade, right? If there are losses, if the fund goes out of business, the banks may be holding it. And my response, this was something I wrote on X at the time, was whether you agree with the Trump tariff strategy or not, can we all just agree that having too big to fail institutions that alter national policies is a bad idea, right? I mean, people are really speculating that we changed our national economic policies to make sure that banks didn't fail. This is insane. The right answer here is we either let them fail or we force the banks to reduce systemic risk. China, by the way, what they did was they increased their tariff rates and their threats, right? So they raised tariffs on U.S. goods being sent there. And then they made a whole bunch of threats and they raised their own tariffs. They lobbed some childish public insults. And the one that to me was really telling was they threatened to stop respecting the IP of U.S. companies operating in China. They flat out said, hey, if you're a U.S. company operating in China, we might steal your property and start companies to compete with you on that. This is something that China has been doing for years. It's something they claim they haven't been doing. And I think that move tells you a lot about the business ethics of the CCP, that stands for Chinese Communist Party. And to use their language, we urge them to abandon their wrong thought and apologize for their wrong action.
Interesting stuff here, Gary, and we'll be sure to keep you in tune with everything that's happening with the tariffs, especially over the next 30, 60, 90 days as we get more insight and clarity into what's actually happening. You're watching this week's version of the 5 Things from Deep Knowledge Investing. This is the tariffs for one issue. Be sure to subscribe to our YouTube channel. Give us a like, comment, or thumbs down if you disagree. Let us know why. Head over to deepknowledgeinvesting.com. Sign up for a free subscription. That'll get you added to our mailing list, get you notifications on new content being added to the DKI website. Gary, moving forward, we're talking CPI back in the news. Consumer Price Index is what that stands for. Came in light. Nothing the Fed can do is what you're saying. Thing number 3, Gary, CPI comes in light and the Fed is sidelined.
So, Rob, when people talk about inflation, they are typically referring to the CPI or the Consumer Price Index. When people say, inflation is up 2%, 3%, 9%, they're referring to the CPI. It's been a little while since we've got a CPI report that surprised people, and boy, this one really did. The March Consumer Price Index came in at 2.4%. That was a huge decrease versus the prior month's 2.8%. That's a big change. There also was a monthly decrease of 0.1%, indicating a small amount of monthly deflation. That was interesting to see. We have not seen a negative number there in a while. The core number is still sticky, but it was down as well. So the core CPI and the core number excludes food and energy. That was at 2.8% and is now below the lows of last year. Lower fuel prices were a big tailwind, something we're going to talk about later in this edition of the 5 Things. And we're also finally starting to see some more realistic numbers in the constantly understated food category. This is something I've been pounding on for years now. The Bureau of Labor Statistics keeps telling us that food inflation has been 1 or 2%. I'm dying to know, for those of you watching this, how much are your grocery bills up? If they're up only 1 or 2%, I would love to hear it because you'd be the first people to let us know that's the case. But in this case, this last month, the monthly increase in the food categories were in the 0.4 to 0.5% range. Is that a lot? Yeah, it is, because it annualizes to 4.9 to 6.2%. So they're basically saying, yeah, we're tracking food in the 5 to 6% inflation range. That may still be understated, but at least it's a lot more realistic than the 1 or 2% we've been seeing. Housing costs continue to rise. Best case scenario there is it would take a few months for potentially lower mortgage rates to work through the long sales cycle in real estate and potentially unlock some of the supply to come onto the market.
Gary, with those points, what are the implications? Speaking about the Fed, what does this mean for the Federal Reserve?
So a lot of people, when they saw the report, thought, wow, this is terrific. This gives the Federal Reserve room to cut. Now, certainly this does give the Fed some breathing room, but I don't think the Fed is going to cut at the upcoming meeting. I think the people who are saying this does give them some breathing room, I think that's true. They're in a better position than they were at the beginning of the year. But they're not going to cut based on this. The big concern that I would have, and this is something, Rob, that we've been talking about for months, actually half a year at this point, is that the Fed doesn't matter as much anymore. It doesn't matter what they do. And the reason for that is the Fed's balance sheet is still huge. Despite taking down a couple $1 trillion, it's still a $7 trillion balance sheet. The real interest rate, this is a graph that Cashin did before, that's still below 2%. So the real interest rate is your Fed funds rate less inflation. That's still below 2%. And more importantly, at this point, inflation is being caused by overspending from Congress. It's no longer being caused by too low rates from the Federal Reserve. And I don't expect Congress to reduce spending. So basically, if the Fed cuts right now, they can cut the overnight rate, but people act like the Fed controls the whole yield curve. They don't. And this is, again, a reminder that back in September, when the Federal Reserve cut the Fed funds rate, the yield on the 10-year Treasury rose by 100 basis points. It rose by 1%. So I think what that's telling you is people are very concerned about overspending out of Congress. They're concerned about debt. They're concerned about increases in the money supply. At this point, I don't think there's a whole lot the Fed can do that will really move the needle one way or another.
Great stuff there, Gary. And as new CPI reports come out and numbers, will keep you in tune with those. Gary, we're moving over to the junk bonds. We saw junk bond yields surge, sell-off intensified. The question that you listed is, are you watching the default rates? Gary, we're moving into thing number 4, junk bond yields surge as the sell-off intensifies. Tell us what's happening with these bonds.
All right, Rob. Well, let's give people a little background on this. I'm sure people listening to this have heard the term junk bonds and wondered what they are. So a junk bond is a corporate bond. It's not a government treasury. It's a bond that would be issued by a company. And the junk bonds are bonds that are below investment grade level. It basically means high yield bonds where people are concerned about the risk of being repaid. The yields on junk bonds have been surging following the introduction of the Trump tariff discussions. And it's the biggest sell-off in the junk bond market since the 2020 COVID-related sell-off. Now, that wasn't that long ago, but, still a pretty big number. So for people who are wondering, what does all of this mean? The easy rule of thumb to contextualize yield is to understand that it's a measure of risk. Typically, things that are lower risk, you get paid less for it, right? Be like, if a billionaire owed you $100, you wouldn't really worry about the repayment risk because they can. It's not a big deal. If somebody who has maxed out all their credit cards owes you $100,000, you may have a problem, and somebody's going to want a higher interest rate for that. So because of that, when there's economic stress, we typically see movement in junk bond yields before other yields because investors will be the quickest to flee higher risk assets in case of uncertainty. When they do that, those yields go up, and that's what we're seeing. So according to the Bank of America US High Yield Index, junk bond yields rose 111 basis points. That's 1.11% just in the first week of April. And the spread between junk bond yields and the U.S. Treasury 10-year yield was up by 116 basis points. That's 1.16% over a 5-day period. That is a huge move in a short time.
Gary, with that, so you're saying that pricing, the market is pricing in more risk on low equity corporate bonds. What else are you going to be watching from here on out?
So I think you called it at the beginning of this segment, Rob, when you talked about default rates. And this is something that, we watch for both consumers and for corporations. And so the question is, and we had the earlier segment with Dean Smith of Folio Beyond, where he said, hey, listen, it takes a while for these things to move this through the system. And it's true. Nobody who is 30 days late gets collected on. You have to go 90 days before anybody tries to collect. And so, the thing to watch is, will this increase in junk bond yields and the increase in the junk bond yield spreads over treasury bonds lead to more defaults down the road? Because here's the thing, a higher yield on bonds that eventually get paid doesn't really matter. It simply means that the original buyers of those bonds will either lose a little bit of money or earn a lower return, and the subsequent buyers of those bonds will earn a higher return. And, that's basically a, like a zero-sum game amongst bond investors. And that's not really that big a deal. Where it becomes a big deal is if those bonds don't get repaid, right? So higher risk, higher yield, pay your bills, it'll all be fine. If we start to see higher default rates, then we have an economic problem.
Gary, we're going to move right to thing number 5. We got an extra thing on this week's version of the 5 things, but we're talking about oil prices. It seems they're responding to greater fears of economic turnover or turmoil, higher inventories. We're really looking to understand, okay, what does the oil market look like moving forward? Gary, thing number 5, oil futures on edge. What's next for that market?
So, Rob, we talked about this a little bit in a recent edition of the 5 Things. I think it was last week we were talking about Brent crude pricing. This week we're talking about WTI. That stands for West Texas Intermediate. To give people, just sort of your shorthand for it, think about Brent as the international price, WTI, West Texas Intermediate, as the U.S. price. Now, if people want to point out that's not exactly perfectly true, it's close enough to give you a sense of what's going on. And yeah, those prices tend to track each other. And so last week we were talking about Brent crude prices, I think around 64. When we did the chart on West Texas Intermediate, it was just above 60. I think it was a 61, 62, something like that. So they tend to be pretty close. And what we've seen is prices have come down since the tariff announcements on 2 things. One is fears of a future worldwide recession. And when the world has economic problems, energy usage slips. And because oil is priced at the margin, meaning the last barrel of oil is really what sets the price, small increases or small decreases in oil demand tend to have a huge impact on price. And the other thing that's happening is OPEC producers are raising output, which is putting the US into a surplus, and we're seeing inventories go up. And so all of those things are working together to get oil prices down. Now, that may not be great for the market, but it's not so bad for US consumers. As a reminder to people, oil is a huge part of the costs that go into almost everything that we have. And, for people who say, well, no, I bought something that doesn't have oil in it. Yeah, but there's energy required to produce whatever it is you just bought and to have it shipped and trucked to the factory, to the store, to your house. Energy usage is just a huge part of the cost of things. And so that is one of the reasons why the CPI, which we were talking about earlier in this episode, was lower. Energy prices were down a lot.
Gary, so there's a big market dislocation here. How does that get corrected?
Well, so Rob, there's an old expression, and I'm not the one who came up with it, is that, and it's going to sound like a tautology, but the cure for high oil prices is high oil prices. The cure for low oil prices is low prices. And here's what that means. Let's imagine for a minute that we're short on oil supply, inventories are low. That will send oil prices up. As that happens, marginal producers who have closed down wells or might be producing at low levels say, well, wait a minute, at this higher price, there's enough profit here that I will reopen wells. I'll start pumping. Or, if they're pumping a well at a slow rate, they may produce more from that. They do have a certain amount of control over that. And doing that will bring more supply onto the market and reduce pricing pressure, lower prices. Well, it's the same thing in the other direction, right? Generally, sort of the rule of thumb is the shale oil and fracking in the US, that break even, that number where producers will start or stop producing is right around $60 oil, which is right around where we are now. So if oil drops much further, then we're going to see the marginal US producer say, you know what, we're going to slow down production. And what that will do is that will reduce supply, it will reduce the excess in inventory, and you end up with higher oil prices. So basically, there's not a whole lot that has to happen. The market actually fixes it by itself. You just need to be a little bit patient.
Great stuff, Gary. For the last thing, the sixth thing, bonus thing this week, we're going to move into educational topics. Before we do that, be sure to head over to deepknowledgeinvesting.com. Again, you can sign up for a free subscription, get added to our mailing list, or we have premium subscription at $100 a month. That's going to get you access to all premium gated content, current recommendations, when Gary's buying, when Gary is selling, as well as many other features for premium subscribers. Moving on to the final thing of this week's version, the tariffs for one issue. We're talking bonds, preferred stock, common stock. We're going to introduce Cashin Crow here, DKI's newest intern. Cashin, what do we kind of need to know just at a high level about these three items here?
Yeah, so these three items are basically the main three ways that a company raises equity or debt. So it's the main three categories of a company's capital structure. And it's really important to understand the difference between them when it comes to your risk tolerance and how you want to try and profit from a business's success.
Awesome. Let's start, Cashin, with corporate bonds. Tell us a little bit more. What does maybe a beginner, intermediate investor need to know about corporate bonds?
Yeah, of course. So a corporate bond, like your average bond, but with a company, is going to be a loan to this company in exchange for a promise to receive that money back in the future, and you're able to receive interest payments on that loan at a specified coupon payment. And corporate bonds, the risk is the lowest out of these three, but income is also the lowest. So it's really good for an investor who wants steady, predictable income. And it's not a slice of ownership in the company, and you don't receive ownership dividends, voting rights. Sorry.
No
Um,
worries.
so yeah, you don't receive ownership or voting rights in the company, but overall, it is a steady, predictable income. And basically, the only downside of corporate bonds is that a lot of times inflation can make your return a little bit lower than what you hoped for in the future.
Let's move Cashin now into preferred stocks. So obviously with corporate bonds have a little bit of a lower risk. Tell us kind of differences with preferred stock or what investors need to know about what a preferred stock is and how it works.
Yeah, so moving on from debt to equity security, preferred stock is an equity security, but a lot of people like to think of it as a hybrid between an equity security and debt because the risk is still relatively low, but there are opportunities for a little bit of higher income. And with preferred stock, the way an investor makes money is on dividend payments um, based on a percentage of the par value. So it is still predictable income. It's steady, but the risk is a little higher, which gives you a little bit higher chance for income. So overall, you do have ownership in the company this time, but you're still not receiving any sort of voting rights. And the main downside of preferred stock is, oh, sorry, I meant to say just the main thing about preferred stock is that a lot of times these issuances can be converted into common stock at a predetermined ratio.
That's right. Yeah. So speaking of common stock, Cashin, I think that's probably what beginner investors are most familiar with, right? When we see things trading on the market. But tell us more about common stock and what to look out for there.
Yeah, of course. So common stock is your most average equity security. And a lot of investors choose this because there is an unlimited upside potential. So you do have a lot more risk, even though you have limited liability, there is a lot more risk than the other two, but you're able to receive profit sharing in the form of an increase in share price. So with common stock, you have both ownership and typically voting rights. However, the only caveat with those voting rights is that sometimes they are diluted with super voting share classes owned by management and founders of the company. But overall, investors choose common stock because they have the highest upside potential, and they're really good for investors seeking long-term capital appreciation.
Great breakdown there, Cashin. So yeah, I think you got kind of the spectrum of risk there, different hybrid types of stocks when we're talking about corporate bonds, preferred stock, and common stock. Cashin, to close it out, let's say there is a bankruptcy. We talked a little bit about liquidation in the written version of the 5 things, but what happens with each of these, the bonds, the different types of stock in the event of a bankruptcy liquidation?
Yeah, so this is something really important to take into account when investing into one of these three. And it's that when a company goes bankrupt, what they're going to do is take their assets and sell them off in order to repay these debt and equity holders. And they do so in a specific order. So first you have corporate bondholders, then preferred stock, and then anything left over would go to the common stockholders. And this is important to take into account because if you're investing, let's say, into a company that's got a lot of debt, you really want to pay attention to their balance sheet. If they don't have a lot of assets to pay off that debt, then investing into something like common stock at the bottom of that capital structure is going to be your most risky option because you are the least likely to be paid back off of your initial investment.
Excellent stuff, Cashin. Thanks so much. Cashin, why don't you give a little background for everybody listening, just about you, what you're working on, where you're going to school. I know Gary mentioned at University of Tennessee, but if you want to do a quick intro for everybody.
Yeah, of course. So yeah, my name's Cashin. I'm a freshman at the University of Tennessee in Knoxville. I'm majoring in finance and accounting. And yeah, that's about it. I just joined with DKI here about a month and a half ago, and it's going great so far.
Awesome. One fun fact about you.
I love typing.
Typing?
Yeah, I love
All
typing.
Right.
I did not see that coming.
I'd say on average probably about 95. So it's pretty good. Nice. It's not great, but
that's pretty good. That's pretty good. That's pretty good. Well done, Cashin. And yeah, Cashin has been awesome working directly into deep knowledge investing. I know working right alongside with Gary and adding tons of value. And thanks so much for all your contributions to the 5 things. A lot of work going on behind the scenes to produce not only this segment, but also the written version of the 5 things on a week by week basis to keep you in the know about everything you need to know in investing for the week. With that concludes this week's version of the 5 things, the tariffs for one issue. Again, be sure to head to deepknowledgeinvesting.com, sign up for a free subscription. That way you won't miss any written version of the 5 things. We'd love if you'd subscribe to us on YouTube, like, thumbs up, thumbs down, leave a comment, ask us a question, whatever your heart desires. Gary, I will turn it over to you for the final words of this week's 5 things.
Thanks, Rob. I thought that was a great explanation of the capital structure by Cashin. Really interesting. For people who are wondering about the practical applications of this, you will often see seniors, older people being pushed toward bonds. And the reason for that is there's less risk. It's harder to lose money. And you basically need a bankruptcy to lose money in bonds if you're holding them to maturity. For preferred, you often will see sophisticated investors there because those securities will often be held as part of a pairs trade. People will often, own the preferred, get the yield on that. They'll short the common against it. And, it's not so complicated, but they're relatively sophisticated investment strategies for hybrid securities that it's not that an amateur investor couldn't do it. It's just that professionals are doing that all day. For me, I tend to focus on common stock. On most of my portfolio, with the exception of Bitcoin, is in common equities. And the reason for that is because I know these companies really well. And so I want the upside, right? I want the upside of, having my view validated by the market. The other thing, too, is something we've been talking about for years. My concerns about congressional overspending and future inflation, I think, are greater than the market as a whole. I don't want to own bonds here because you really are capped. You're going to be paid back in dollars, and they may pay you back in dollars. The question is, what can you buy? If you buy 5-year paper, if you buy a bond that matures in 5 years, and so you give them $1,000 and 5 years, they pay interest, they give you your $1,000 back. The question is, what can you buy with that? And my fear is that it will be a whole lot less. And so That's, how I view those things and why my portfolio is very heavily weighted toward equities. Separately from that, it was, one heck of an exciting week. The week here is off to a huge start already. Lots of interesting volatility already, lots of news. I think, next week's 5 things is going to be a fascinating addition. Cashin, we're counting on you to get started on that immediately. Great job by Cash and Crow in not just the segment that he beautifully explained to us, but for doing just a ton of work on the 5 things. We also want to give credit to Matt Pettit, new DKI analyst from the London Business School. He did a great job contributing to this week's 5 things and also being a participant in the tariff discussion we had with Alex McCrease. And as always, Rob, want to thank you and the team at Flying V, Nazim, Anton, Alex, Jonathan, just, the guys here at Deep Knowledge Investing have gotten a ton of support, and we have you to thank for that. And then for everyone else watching this, we know your time is valuable. Thank you so much for spending with us. It's nice if you want to give us a like and subscribe, but hey, we're not the boss, so you do whatever you want. Looking forward to seeing you next week.
Thanks, everyone. Have a good one.